Oh, sure. Okay, Ruchira, you can start. Ruchira, okay, why don't you start? Yeah.
Okay, Professor. So, very good afternoon, ladies and gentlemen, especially for those who are joining from this part of the world. And we have one speaker, and also I think there may be some participants joining from other part of the world, maybe from the USA. So, to them, a very good morning. My name is Ruchira Pereira. I am a council member of CMA Sri Lanka. So, on behalf of the institute, which is the National Professional Management Accounting Institute in the country, let me warmly welcome you for this very interesting and also much anticipated webinar, domestic debt restructuring, which is also known as domestic debt optimization, to discuss how it will impact various parts of the economy. As we all know, this is a very interesting topic today. Many people are expressing their views, many have different opinions. But today we are privileged to have two eminent speakers. I would say two eminent economists to discuss about the concept, to take us through the concept of domestic debt restructuring, to explain us the process, and also discuss the impact of this process on the wider, on different aspects of the society. So I'm sure during their speeches, they will also shed light on fragile economic situation of the country and also debt sustainability issues. Our session today will be moderated by Mr. Talal Rafi. I will introduce the speakers and also about the moderator a little later. But to start the proceedings now, let me invite very respectfully the founder president of CMA Sri Lanka, its incumbent president, Professor Lakshmana Vatawala, to address the audience. Over to you, sir.
Thank you, Ruchira. Good afternoon to our eminent speakers, our moderator, our council members, our participants, the fellow professionals. Let me welcome you to this webinar that we are having on domestic debt restructuring, handled with care. As you know, recently we also had one on the extended fund facility, and today it looks that everything is going in stages. So the first stage of the extended fund facility was okay, but now we have come to the second stage where the domestic debt restructuring is concerned, and I know that there is a great interest. It's not only from the professionals, but also from the banking sector, the industry sector, and also a lot of individuals who are really interested to find out what is really happening. So we are very happy that we have two eminent speakers, Dr. W.A. Vijayawardena, the former Deputy Governor Central Bank, and also Professor M. Udara Piris from the Oberlin College in the USA, and our moderator, Mr. Talal Rafi, who is also an economist and a member of the Deloitte Global Environment Economist Network. So you all know that we are, of course, in the accounting profession, but we are really wondering as to whether we are really contributing something, or the others are always doing everything and we have to see what is happening. But actually, to tell this story, we are having the economists today, but I must tell you that we are also extremely concerned as chartered accountants, as management accountants. We are extremely concerned because the country has come to this situation which no one thought or no one heard that this would be the situation for us. So what we are wondering is whether the balance sheets, the profit and loss accounts, the income and expenditure, the cash flows, which we talk so much. Today the government is talking of expenditure control. But of course, as the management accounting body, we have costing, we have expenditure control, everything. But I don't know whether they should consult us or whether we should tell them what has to be done, but they have to listen to us. because if expenditure control and the cash flow statement, increasing the income, all are matters, because if you are looking at debt sustainability, then certainly these things will come in. As far as the economists are concerned, I know they are here, but they will say what should be done, and we must increase our income, we must reduce our expenditure, we should maybe bring in foreign exchange. All these things are there, but actually when you go to do it, we need to look at these areas, and the government has to, if they want to do it, then they need to really look at. So now, looking at one of the latest statements of the IMF wants Sri Lanka to finalize strategy on domestic debt restructuring. So we have to find a strategy. Then once a strategy is defined, you have to have an action plan. Now, those are the big problems that we are having, because once someone is in a very difficult situation, one is unable to repay the loans, then the banks are going to put conditions, because these not only IMF, even local banks will not even look at you if you can't repay. So I think it's a great achievement, I should say, at least, that they have been able to go to the IMF. And although we are in this very critical situation, they have come up, they are prepared to fund us, but then we need to correct ourselves if we are going to do it. So from the accounting side, we feel that there are very many areas, maybe on the management accounting side, the chartered accounting point, the auditing point, the financial control. These are all very essential things if we are really going to have a sustainable debt management system, because that is what the IMF is talking of. So I'm sure that today we, while taking note of those things, we are very happy that we have those in the economy side, and who will be able to tell us what is the current situation. Everyone is interested, as I said, the public, the society is the ultimate person who will have to receive all the wrongdoings and the right things that the government is doing, the government and the bureaucracy, what they are doing. But if they don't join with the private sector and do it on a public-private partnership, I don't think that they will be able to get over this problem. So that's another thing that they have to keep in mind. The government, even the IMF, should know that it is not only privatization, but it is public-private partnership, where the professionals, where the other technologies and others will get involved in the process to have debt sustainability. So with those opening remarks, I hope I hand you over to Mr. Ruchira Perra, who is one of our council members, in order that he could conduct the webinar.
Thank you, Professor. Thank you very much for your opening remarks. I hope that will pave the way for our discussion today. So as I have mentioned you earlier, we have two eminent speakers, two eminent economists to discuss about this topic, followed by another economist from Deloitte to moderate the session. So let me now first invite our first speaker for the day, Dr. W.A. Vijayavardhana, who is no stranger to CMA Sri Lanka. He has been a frequent panelist and also presenter in CMA webinars. He is a former assistant governor of Central Bank of Sri Lanka. Deputy Governor of Central Bank of Sri Lanka. Pardon for my mistake. Currently, he is serving in the Board of Studies of Faculty of Graduate Studies of University of Sri Jawaharlal. Doctor, we would like to hear your thoughts first on this topic, and maybe once you finish your topic, I can ask from Professor Udara what else that he has to add on the topic. Thank you, Doctor. Over to you.
Thank you very much, Ruchira, and what Professor Laxman told us right now about the stand taken by the International Monetary Fund with regard to Sri Lanka's domestic debt restructuring. It conveys a good news as well as a bad news. Of course, the good news also will become bad, if you look at it from an economic point of view. Good news is that the IMF has just, washed its hands, saying that they have no any intention of compelling the Sri Lanka government to go for a domestic debt restructuring. It is entirely a matter for Sri Lanka government to decide. And but of course, given the current IMF program, the extended fund facility under which Sri Lanka government will have to cut down its expenditure levels drastically. Sri Lanka economy has to cut down its expenditure levels drastically, which we mean that the aggregate demand in the Sri Lankan economy will be curtailed drastically as a result of that. Even though the IMF says that it doesn't impose a binding condition for Sri Lanka government to go for a debt restructuring program, it seems that there is no any other alternative available to Sri Lanka government. The bad news is Sri Lanka government finances are in such a horrible state that there is no any choice for Sri Lanka government except going for a debt restructuring or actually the debt cancellation program. I will actually explain the situation like this. Now, if you take this year 2023, the Sri Lanka government budget, they had expected a certain revenue for the government. It was originally estimated at 3.4 trillion Sri Lanka rupees, but now they have scaled down into 3.2 trillion Sri Lanka rupees. And recently, you would have noted the Department of Inland Revenue was, went into a euphoria, saying that, in the first quarter of 2023, their revenue generation was 116% above the revenue that they had generated in the same quarter in 2022, which is a wrong comparison. The comparison should have been the target that had been given to them by Parliament, which is about 500 billion Sri Lanka rupees for the first quarter. Out of the 500 billion, they had got only 316 billion as revenue. So the revenue attainment, if we call it the revenue yield rate is about 63% of the target. So that means even the revenue of 3.2 trillion, which the government is planning to get, we are not going to get it if we are to have the same performance in the balance part of the year, in the respective three quarters. So what it means is that out of the 3.2 trillion, most probably we might get 70% of that, which is again, we are underperforming with respect to revenue. Then comes the total gross expenditure. Now, usually when the budget numbers are presented in Parliament and also when it is presented to parliamentarians as well as to people in Sri Lanka, they always talk about the net financial requirement of the government, assuming that whatever the loans that are to mature during the year, the government would be able to refinance them, and therefore there is no financial problem for the government. For example, if a treasury bond of 100 rupees would mature this year, if the government is able to reissue the same treasury bond and get money, then it doesn't affect the government's net cash flow. But what matters is, Sri Lanka is in a financial crisis now. With respect to foreign loans that are to mature in 2023 and beyond, we are not in a position to refinance the same by borrowing from the market. So that is why Sri Lanka's foreign debt had been classified by IMF as early as February 2020, that is not sustainable. We didn't have the same thing. We don't have the same thing with respect to the domestic debt, because the assumption there is, since the government has the power to print money, you can always print money and repay the domestic debt when it comes to the domestic debt of the central government. But the domestic debt of the public sector is completely wider. It's a wider concept. It includes the borrowings by the central government, borrowings by the provincial governments and local governments, borrowings by the government corporations, borrowings by the state-owned financial institutions like People's Bank and Bank of Ceylon, borrowings by the Central Bank of Sri Lanka, and also if there is any borrowing done by the private sector on a guarantee given by the Treasury, those borrowings are also included in the wider public sector. And Sri Lanka government is presently planning to optimize only a part of that. That is the debt contracted by the central government of Sri Lanka. So we have to keep that in our mind. The second one is that following the presentations by the British economist David Ricardo about, say, 200 years ago, the actual burden that could fall on the taxpayers of a country is not the current taxes they are paying. For example, we are to pay about, say, taxes about into 3.2 trillion in 2023. But Ricardo says that the actual burden is much more than that. If the government borrows money today to finance its deficit, future taxpayers will have to pay more taxes to repay that debt. So that means what he says is the actual burden is the current taxes that they pay and the taxes they have to pay in the future to repay the current borrowings by the government. And during Ricardo's time, we didn't have the third concept. The third concept is the money is printed by the government in order to finance its expenditure program. That money will lead to inflation and there will be an inflation tax. So therefore, there are three types of burdens that are to be borne by Sri Lankan taxpayers today. The current taxes that they pay, future taxes that they have to pay in order to repay the domestic debt, which the government has borrowed, and also the inflation tax, which is now running at around, say, 50% of the money income of the people. So all these factors would be a burden to Sri Lankan citizens. I will say Sri Lankan citizens, the taxpayers, Sri Lankan citizens. And the present level, when the budget was presented and when the IMF program was designed, the gross expenditure of the government had been actually estimated around 11.7 trillion Sri Lanka rupees. But when the central bank and the Minister of Finance met the bilateral creditors on 30th of March, the gross expenditure of the government had been scaled up to about 14 trillion Sri Lanka rupees. And we are to get the revenue of 3.2 trillion, but it seems that, we may be able to get only about 2.5 trillion. So we have a huge gross financing requirement, which is a part of the IMF program. IMF program requires the government of Sri Lanka to cut it down. Presently, the gross financing requirement for 2023 is about 35% of the GDP estimated for 2023. The GDP had been estimated around, the 29 trillion, but close to, say, 30 trillion Sri Lanka rupees in 2023. So 35% of the gross financing requirement of the government is huge. And for that, that includes the repayment of the domestic debt by the central government, because they go by only the narrow definition of domestic debt. And that includes the treasury bills issued by the government of Sri Lanka, treasury bonds issued by the government of Sri Lanka, and Sri Lanka development bonds denominated in US dollars issued by the government of Sri Lanka. With respect to the third category, already the government has defaulted them because the maturing Sri Lanka development bonds are not paid in US dollars. They are paid in Sri Lanka rupees, subject to a delay, time delay. There's a delay of about 2 to 3 months' time, depending on the availability of cash with the treasury, they must repaid. So it has already been defaulted. So the other two also will be defaulted as it is, the government is not going to get revenue. And at the same time, the expenditure is, 14 trillion Sri Lanka rupees, and it might go up further because of the present policy of the government not to cut its expenditure program. So as a result, we are in a big problem. So when the central bank says that the domestic debt optimization is voluntary, it is just like, I hold a gun at the neck of a person, at the throat of a person, and I will ask him to your life for your money. And it's not a voluntary one. There is no any voluntary decision to be taken. A voluntary decision in terms of economic season, whenever you have a large number of options available, if you are free to choose one, then it is voluntary. For example, when you go to, say, a supermarket, and there are many brands of, say, milk food, about, say, 10 to 15 brands of milk food, and you choose one, and that's a voluntary choice. But suppose there is only one brand, and the availability of that brand is also limited. In that case, even though you make the choice on your own, it's not a voluntary choice. It's a choice that has been delivered to you by the economy. In the same way, and if you go to a supermarket and if you want to buy eggs, situation is also like that. So when the economy is, underperforming in this manner, you can't repay your debt. And those Now, one disturbing factor had been announced yesterday by the Ceylon Electricity Board. It had increased the tariff of the electricity board in February 2023. And the promise that it gave us was that it is able to write off its all the debt, all the losses, and it might make a profit in the coming years. But the first quarter data have been released now. According to the first quarter data, the operational loss of the Ceylon Electricity Board is about, say, 19 billion Sri Lanka rupees. And when you add another 15 billion amounting to the financial cost of the Sri Lanka Ceylon Electricity Board, then it comes to 34 billion Sri Lanka rupees, the losses. But all the accountants who are present here in the audience, they know what you must be worried about, not the profit after the financial cost, that's the interest. So what you are worried about should be the profit after the interest cost, the depreciation, and the taxation. So that is why we are calculating net profit. Now, in the case of the Ceylon Electricity Board, the numbers that have been presented do not contain depreciation. The depreciation part is huge in the case of CEB because they have invested a huge amount of money in capital infrastructure. And when you depreciate them, the losses are more. And what matters here is that Ricardo's, definition of the burden of the citizens of the country. Now, if the Ceylon Electricity Board has to be recapitalized, it will become a burden for us. And you will be noticing that the government is having an enormous financial cost here in terms of finance, accounting, as well as in terms of economics. So this is a serious situation. So when we look at this situation and when we evaluate the present situation of the government, in my view, whatever that is offered to the domestic debt owners, already the holders of the Sri Lanka Development Board, they had to take a big hit because they don't get whatever they have invested in US dollars. They get in Sri Lanka rupees subject to a time delay. And the investors have been mainly the commercial banks. Commercial banks have invested in Sri Lanka development bonds by using the money that they get for their NRS accounts, which are now redesignated as the private foreign currency accounts. And they have don't asset, but they have a liability. So the people who have their money in the private foreign currency accounts with bank are not able to get dollars from in foreign currency as agreed by the banks at the time of opening of those accounts in foreign currency. And therefore, there is already a default by the government of Sri Lanka. A similar default might come because of the very tough IMF program. In the case of tough IMF program, now earlier I said, the domestic debt is not considered as a problem for a government because it can print money and give money there to government. But the present IMF program, it has put a cap on the central bank's lending to government of Sri Lanka. So no more money printing in terms of the IMF program, and also no more money printing in terms of the new Central Bank Act also. So there is no any possibility for Sri Lanka government to get the Central Bank of Sri Lanka to print money and hand over that money to government to repay the domestic debt amount, involving the issue of treasury bills and treasury bonds. So that there is a big problem there. In fact, the Sri Lanka Central Bank has to, in terms of the IMF program, cut down its debt portfolio to government of Sri Lanka by about, say, 200 billion by the end of the year. It's not an expansion, it's a curtailment. And that particular position has to be maintained throughout the period of the IMF program. So that one option available to government of Sri Lanka is out. The second option is to borrow from the market, and the central bank is doing an excellent job right now by getting everything from the market, by allowing the interest rates to remain around 23 to 24%. Earlier it was 30%, but of course, given the current situation where the central bank is unable to intervene and push the interest rate down in terms of the IMF program, as well as in terms of the new Central Bank Act, we have to expect the interest rates to remain at this level, or they have to go up in order to enable the government to repay the maturing debt. But what matters is that since the central bank is, under very constrained financial program right now, because its losses in 2022 had amounted to a thumping 374 billion Sri Lanka rupees, and it doesn't earn anything from the foreign exchange operations right now. And at the same time, if the central bank is not allowed to lend to government or to commercial banks, they don't earn domestic interest rates. So central bank is in a very, very tough straitjacket now, because now we are normally talking about when an IMF program is on, there is an austerity program. But the austerity has really been enforced on the government of Sri Lanka in terms of the present program and the Central Bank of Sri Lanka. Government of Sri Lanka cannot borrow from the central bank, and the central bank cannot lend to government of Sri Lanka and earn interest income. For central bank is in a big trouble today. So what I mean is that given this bad news, we will have to wait for a very dangerous situation, alarming situation with respect to domestic debt, even though the central bank and the Minister of Finance say that it will be voluntary. It will not be voluntary. It's just like a gun, held against your throat, and you are asking to make the choice of your money or your life. So these are many things that will be, that has propped up. I think Ruchira is now very concerned about the timing. So I'll stop at this level, Ruchira, and we will talk about this later in more detail during the discussion time. So thank you very much.
Thank you, Dr. Vijayawardena. Thank you very much for explaining that debtors have no choices. You have clearly explained that even though it is termed as a voluntary debt restructuring program, that in effect, it is not voluntary, but we will be forced to do that. Thank you very much for your views, Doctor. Now let me turn to our next speaker for the day. He is from USA. I know this time is very early morning in the USA. Thank you, Professor Udara, for joining us. Let me briefly introduce Professor Udara to you. He is a visiting associate professor of economics attached to Oberlin College and Conservatory in the USA. And Professor Udara has obtained his MSc and PhD in financial economics from the Oxford University of United Kingdom. Professor Udara, we are privileged to have you with us today, and thank you very much once again for joining at this time. So over to you, sir.
Thank you very much, and I'm very glad to be part of this panel. I think it's a very important event. And I say always, I think it's very important that there's public scrutiny of whatever the government, whichever government's in place is doing, and professional bodies like the CMA are very well positioned to be able to provide this scrutiny for the public good. So a lot of what I will say will complement what Dr. Vijayawardena just spoke about. But I have some slides which will probably touch upon a few slightly complementary things. The slides visible?
Yeah, Professor, we can see the slides.
Okay, excellent. All right, so let me first just start with the mechanism, at least a simplification of the mechanism that we have in mind of what has been happening. So we saw first, essentially, the root cause of the crisis was a large expansion of the money supply, which coincided with the period of the COVID lockdowns, which resulted in an increase in the pressure on the rupee. There's a depreciation of the rupee. Then there was a result in inflation because of the increase in the cost of imported goods. The inflation caused real interest rates to be negative. Then as real interest rates are negative, people prefer not to hold financial instruments like rupee bonds and prefer to hold real assets, as we say, such as foreign assets or physical assets such as property. The shift away of demand away from rupee bonds towards other assets then creates a reduction in their price, and because they're bonds, a higher borrowing cost for the government. The higher indebtedness and the higher borrowing cost for the government then requires further monetization of the debt and further inflation. And so this vicious cycle that we've seen is really coincident with the question of the sustainability of debt. And as debt grows and as yields on debt increases and borrowing costs of debt increases, debt becomes increasingly more unsustainable. And we are heading, it seems, in the direction of where something really needs to be done about it. So the analysis that I'm going to present is coming to a large extent from a report that I released together with Verite Research back in October 2022 called The Desirability of Domestic Debt Restructuring. I'll give a QR code at the end where you can find the link. But if you just Google the title, you'll find the report, and we have an Excel sheet with all of the analysis there transparently given, and I'm very happy to be scrutinized on this as well. But I think it's very important to really get into the numbers and to work with the assumptions rather than kind of work off back of the envelope calculations. So this is part of a project, as I said, with Verite Research and the Sri Lanka Economic Policy Group. So it includes Shanta Devarajan, Nick Moore, Dilini Gunawardena, and of course, Nishan Dimel. So we advocated back in October to consider domestic debt restructuring. And there's four main arguments why we think this is something that needs to be considered. First is that it provides a quicker path to debt sustainability and economic recovery. Second, it provides a foundation for recovering macro stability. Number three, it reduces the risk of returning to debt restructuring in the medium term. And this is a very real risk, which I don't think has been appreciated enough in the public discourse. And number four is that it achieves a more targeted and progressive sharing of the adjustment burden. So the point number four, I think, needs to go hand in hand with the discussion of how domestic debt restructuring should be implemented and the costs that should be borne by different sectors of society. So what did we propose? Well, what was the basis of our analysis? We assumed that there'd be a 50% cut in the principal of foreign bonds, ISBs and SLDBs, 50% cut in the principal, and multilateral and bilateral loans would incur a 25% principal cut. For the domestic debt, we assumed a 10% increase in the maturity of the outstanding debt, but no coupon or principal cut. So that's the basic assumptions that we've used for our analysis. And I think they're kind of, at least for the external side, it's over-optimistic on the sorts of haircuts that will be obtainable, particularly on the bilateral loans. In terms of the domestic debt restructuring, the 10-year maturity extension doesn't really matter in terms of the assumptions that we're making. Nevertheless, and so it will give a fairly good conclusion, regardless of how you play around with the type of maturity extension that you assume. So let's get to the core problem. The core problem, as Dr. Vijayawardena pointed out as well, is the yield curve. The line at the top is the yield curve back in August 2022, and it's more or less the same or very similar to what is in place now as of May 2023. So it's around 20-25%. And the bottom line is the yield curve back in 2019. So as I said, the crisis actually occurred not because the government suddenly became more indebted during the COVID time, but because the yields on government debt suddenly jumped up in response to a large extent because of the extra money printing, if you like. So the challenge here for debt sustainability is really how to bring the yield curve back down from the top line to the bottom line. And the sooner this can be done, the sooner debt becomes sustainable, even effectively at the current levels of debt. Even if the yields can come down, then really no restructuring really needs to happen, definitely on domestic debt, and the amount of adjustment needed on external debt becomes much smaller. However, the yield curve, as you know, is a market determined rate and it can't artificially be adjusted. So the question is, how can we get to this point? According to our analysis, Sri Lanka's debt to GDP would increase to around 154% at the current yields without debt restructuring. So without any domestic or external debt restructuring. This would be to 153% by 2032. If there was external debt restructuring, which is the purple line, then debt to GDP would fall to around 94% in 2023, but then quickly rise up back to about 136% by 2032. So this graph's a little bit messy, but let me walk you through it. The light green line here at the bottom is when there's external and domestic debt restructuring. This is at the yields in 2022, but as I said, this is more or less the yields that are currently in place. And the dark blue line is the IMF's projections of debt to GDP. Okay, so let's see what happens if we had 2019 yields in place. And as I said, if we had 2019 yields, debt is sustainable already. There's really, you can see the red line, which is without any form of restructuring, debt to GDP would naturally just come down to around 96% from the 128% it was in 2022. Okay, so the challenge is how we jump from this equilibrium, as we say, as economists say, of the 2022 yields back to the 2019 yields. Now, I guess a more somber thought is what has actually happened. So the red line here is the projections of our analysis that we done in August 2022 is when we done the analysis. This is a chart. Here is the debt in trillions of rupees, domestic debt in trillions of rupees. And we projected that it would get to about 1.22 trillion by March 2023. The blue line is the actual numbers, and you can see there's already significant deviation. So what, or 15% odd increase over our projections. So we're really moving in a much worse situation than what even our analysis showed. So what does domestic debt restructuring achieve? So domestic debt restructuring has been discussed in the context of haircuts and capital losses for the bondholders. I think the better way to think about this, especially in the context of debt of reprofiling and maturity extension, is that what we're really trying to do is to lock in the previous lower cost of borrowing. So we know that if the government borrows in the market, the yields are going to be much higher. So how can we lock in the previous yields? The way we can lock in the previous yields is by extending the current maturity of the bonds. So if the government does this, and if this results to an improvement in government solvency, then naturally the market's response would be to lower the premium on government debt, and the market yields will actually come down, which would mean there wouldn't be a mark-to-market loss on the bondholders by this maturity extension, by this reprofiling. The important note, so we released this monthly Verite Research debt update, and in the latest one we released a few days ago, we showed that the IMF's projections based on the EFF report is based on the assumption that there's a 6.14% decline in yields from the May 2023 numbers. So even for the IMF's numbers to work, we need a 6% decline. So the question is whether this is something the government can directly influence, and of course they cannot. And what can they directly influence? It's basically the fiscal situation, the fiscal budget. I mentioned earlier about the risks of subsequent debt restructurings. So this is a paper by, it was released on I think IMF or a World Bank blog by some, by economists. And you can see here a historical overview of debt restructurings. And you can see that on average between 1970 and 2020, On average, there's 2.1 restructurings that occurred after a sovereign default event. So this means that what we should be anticipating is that it's very likely Sri Lanka will have to restructure the debt again. Now, restructuring the debt again would mean another episode, not as severe as what we have seen last year, but still significant, which will cause significant stress to the financial markets and to the economy. So what we want to really do is to avoid this situation as much as possible, which means to take early action on the restructuring and take large enough action on the restructuring so that we can avoid another round of restructuring. If you look at the ownership breakdown of T-bills, we can see that in T-bills and T-bonds, we can see that T-bills are predominantly owned by the central bank. So this is the form of liquidity injection to the market. But if you look at T-bonds, the superannuation funds hold about 43% of the debt. The banks hold 36%. And then we have licensed specialized banks, 9%. And insurance companies, 4%. So we have around 90% of the T-bonds, which are held by domestic financial institutions. So what must be in the back of many of your minds is, what are the implications of domestic debt restructuring for these institutions? So let's turn to the banks in particular. There was a report I saw actually yesterday, about the profitability of the banks. And it seems that almost all the banks had a growth in profits year on year. If you look at their Q1 numbers, apart from 3 banks, they've all actually increased their profitability. However, this growth in profitability has come on the back of an increase in the net interest margin because of the increase in the yields. And also, I think worryingly is that it's coming together with a fall in the loan book. So essentially, the banks are becoming even more dependent on the state and just financing state operations by trading these treasury bonds. So to the extent that have the banks suffered from the higher yields, the facts seem to say that in fact they have not. What they have suffered from is the fact that the natural loans that they would give to the private sector have declined, and there's a large increase in the risk and the provisioning for some of the loans that have been given because of these higher yields. So we really also want to avoid this situation where, as the yields keep being high, banks become increasingly acting as agents of the government. We really want to start to stimulate the economy through the generation of private sector loans. According to an analysis, the mark-to-market loss from domestic debt restructuring, because of course, if we reprofile the debt at the previous yields, this will incur a present value loss given the current market yields. This will require around 5 to 8% additional Tier 1 capital. However, the numbers I saw yesterday also say that many of the banks already have plenty of surplus Tier 1 capital in place. And so what we would need is an additional increase in Tier 1 capital of around 3 to 6%, which would translate to around 1 to 3% increase in debt to GDP. So the domestic debt restructuring would go hand in hand in additional recapitalization of the banks, which will of course need to be financed by debt again. So how can we achieve this? So what the government can do, and there's different ideas out the government has proposed, but I haven't seen any particular details of how this can be implemented. But the way that it could be potentially implemented is the government creates a new series of long-dated bonds, say of maturities 5 to 10 years, because you want to give the economy around 5 years breathing room where the government can start to restructure and to reform its public finances. So bonds can be exchanged. The bonds that are maturing in the next 5 years can be exchanged for these longer dated bonds, basically locking in the 2019 yields and historic yields for another 5 to 10 years. And the overall yield to maturity can be kept constant. So that means if the yields can come down, there wouldn't be any capital loss of the bonds. The central bank would then need to play an important role by providing additional liquidity through things like repo operations for the newly exchanged longer dated bonds, because the longer bonds would, of course, have less market liquidity. But these additional liquidity from the central bank would be short-term liquidity, as opposed to outright purchases, which would essentially be long-term increases in the long-term amount of cash in the economy. The recapitalization of the banks can also be achieved through a purchase of bank equity in exchange for new bond series. So this will require a change of legislation, but in principle, this can be achieved. And this would also then allow the capital adequacy considerations to be satisfied through the issuance of government debt rather than the creation of cash, which we want to avoid, because this will feed into inflation and high yields. So this is the chart we pulled out from the IMF projections in the May 2023 debt update report. So this is the IMF's projections on debt, and you can see 2023, there's a decline in debt to GDP, which the IMF is projecting. Curiously, the large chunk of this declining debt to GDP is this other term, which we presume is coming from restructuring and changes in market expectations. And a lot of the debate and discussion has been about the fiscal side of the government. So the fiscal adjustment is represented in the primary deficit graph here, which is orange. I don't know if you can see, but it's very, very small. So you can see that the size of the adjustment in debt to GDP that's contributed by an improvement in the fiscal deficit is really quite small. Most of it's coming from the growth rate, which is the yellow line, and the effect of real interest rates and relative inflation. So the point being is that the government's fiscal position is less important than the overall macro stability and macro stability of the economy. Almost done. So the 4 modes of reducing domestic debt: one is through taxation, which the government has been doing; through inflation, which is what's been happening. It can artificially set lower yields, but then this will create really strong frictions and perhaps markets not clearing. And number 4, through domestic debt restructuring. The incidence of the burden, what we're trying to avoid is repressive wage earning on the middle class and increasing poverty, reducing real wages and retirement savings. Number 3, artificially lowering yields will hurt depositors and fuel inflation. And number 4, through domestic debt restructuring, we can shift the burden of the prices away from the poor and the working class and the wage earners towards the holders of equity. So let me skip to this and just get to the final thing. You can see the QR code, which has the workbook. The Excel sheet there's a link there, and the whole report. And yes, please do look at this, scrutinize it, critique it. Very happy to continue the discussion. Thank you very much.
Thank you, Professor. Thank you very much for your very informative discussion. In fact, in your presentation, you have explained the background of this problem, where we were, what actually caused this problem, and what IMF is expecting the government to do. Thank you very much once again for that very informative presentation. So now I would like to turn to our moderator for the day, Mr. Talal Rafi. Mr. Rafi is an economist himself and a member of the Deloitte Global Economist Network. He is also an expert member of the World Economic Forum and regular columnist for the International Monetary Fund. So Mr. Rafi will moderate the session. Of course, I will assist him with the questions that I may get from the audience. Now, before I hand over the moderation to Mr. Rafi, may I request you to forward your questions if you have any, which you need to ask from the speakers under Q&A. I have put a message earlier, but then again, while the moderation is going on, if you have any questions, please forward the questions under Q&A. Over to you, Mr. Rafi.
Right. Thank you, Ruchira. And thanks a lot for the two speakers, Dr. Vijayawardena and Professor Udara. Dr. Vijayawardena spoke about how debt optimization may not be voluntary, and for Professor Udara's explanation on why domestic debt restructuring would be a good option. So, so got some questions, and then I'll be taking some from the audience as well. The first question I'll put it to Dr. Vijayawardena. You mentioned that the domestic debt optimization is not something that's voluntary. So how do you think the government will sort of not directly but indirectly do it? Does it mean that the central bank might refuse to give liquidity support to certain players who don't take part in it? Doctor.
Thank you very much, Mr. Rafi. And if you take the largest hold of the treasury bills, the 62% is being held by the central bank. That's going to be done by Parliament, because if you go through the new Central Bank Act, in the transitional provisions, which is presented towards the end of the act, it's not in the main act, but towards the end of the act says that the whatever the government owes to the central bank, which comes to about say 3 trillion Sri Lanka rupees as at today, will be converted to a negotiable bond maturing in 10 years. Of course, the 10-year time period will be elongated further, and I expect that it will be about say 20 years. So what would happen is that it's not we at the the discretion of the monetary board or the new governing board of the central bank. The Parliament will tell the central bank, okay, we owe 3 trillion to you, we can't pay it. We'll convert it to a negotiable bond maturing in maybe 10 to 20 year time period. And if Parliament approves that, it's a law. You have no choice. So it's not voluntary. And the amount involved is some 2.7 trillion, which central bank has lent to government by way of buying treasury bills, and another 300 billion, which the central bank is lending to government by way of an overdraft, which is called the provisional advances. Now, both these will be lumped together and they will be converted to a bond, which the government will issue to central bank, and it should mature in 10-year time period. Since it is negotiable, the central bank is in a position to sell it in the market if there are buyers in the market. But what would happen is that over the period, the central bank will lose the interest income, which it is getting right now. As I told you, in 2022, massive loss in the central bank. Central bank's salary bill comes to about, say, 10 billion rupees and another expenses of, say, another 4 billion rupees. So central bank will have to necessarily should have 14 billion rupees in order to maintain itself annually. But in the case of the foreign holdings or the foreign exchange holdings of the central bank, there are no earnings because the central bank has now nobody knows about these details. Some $6 billion US credit to the rest of the world in US dollars. 6 billion, which has to pay. I mean, about say 2 billion to ACU, which it has to pay interest on that. Then the SOC facility from China and also from Bangladesh and also from India. And then the money that it has borrowed from the IMF, which is the debt of the Central Bank of Sri Lanka. And all these now, IMF debt, many people think it is, very cheap. No. In terms of the current, say, EFF, the minimum interest rate which Sri Lanka has to pay is about 8%. So it's a very high interest. So when you pay interest on that, and if you don't earn interest from the domestic front, the central bank will have the same problem of, losing its capital, as Professor Udara had, mentioned about in the case of the private financial institutions. The second one is, there is this Employees Provident Fund, which is under the control of the Monetary Board in terms of the EPF Act. Probably government might say, we don't want to pay you, we can't pay you, you make a choice. And that choice will be not the curtailment, not the haircut of the principal, because in terms of the EPF Act, EPF cannot incur any loss in the investment. So therefore, it will be a sacrifice of the interest earnings, which is again the EPF people tell me that the current level of earnings is about 12% per annum average earnings, even though the interest rates have gone up to say now in the case of treasury bonds 22% open rate. treasury bills about, say, it went up to 30, but now it has come down to 22. The EPF's average earnings, because it has invested this money long time ago at very low interest rates, the average earnings is less than 12%. And that is why in 2022, they declared the interest on EPF members at 9% because they don't earn anything. So therefore, if there is a curtailment of the interest income to be received by EPF, as I think Professor Lakshman also mentioned about it, the EPF members will suffer. In the case of the private, the state and the private commercial banks, not yet voluntary, but as I have mentioned to you, it is a proposition, you take it or leave it. Because if the government cannot pay, the government financial situation is so precarious right now, there is no choice for the government also, because the government doesn't seem to be aware of, the precarious financial position it is having. So it is having all kinds of these tamashas and expenditure programs, and there is no cut in the government expenditure. Only cut they have made is with respect to the capital expenditure, which again will affect the economic growth in the future. So when you take these three factors into account, Mr. Rafi, the situation is not voluntary at all. It will be a situation where they will be given only one choice and they will have to take that choice, just like our going to market and buy eggs today from the supermarkets. No choice at all.
Right. Thank you. And just a follow up, Dr. Vijayawardena, do you think like going forward, I think somebody was arguing, like ETF funds, should the government like guarantee a real interest rate of 1 or 2% due to like consistent impact?
No, there is no such thing in the EPF Act. The only provision in the EPF Act is that, which was enacted in 1950, long time ago. The only provision in the EPF Act is that the minimum interest rate is 2.5%. It has to pay, and if the EPF doesn't earn enough to pay that 2.5%, the government can give a loan to EPF so that, but the EPF will have to repay it to government later. In the case of the ETF, there is no such provision of maintaining a minimum interest rate. But of course, when I was in the central bank, we introduced an EPF investment policy statement in year 2003. In the statement, which was approved by the Monetary Board, we had, announced that the EPF should, strive to pay in real terms 4% of interest to members. For example, if the inflation rate is 8%, they have to pay a minimum of 12%. So that one, after I left the central bank, I don't know how it has happened. The same Monetary Board has withdrawn the statement, and there is no more that particular assurance being given by the Monetary Board to EPF members, and the EPF members had also been silent. Nobody had, spoken about it. The Monetary Board had introduced this 4% real return in 2003. The same Monetary Board, after I left it, the central bank had withdrawn it in 2010. So there is no such minimum payment in real terms to EPF members. And this is something which, the members should be concerned. But why I say it, Mr. Rafi, is that if the rest of the economy gets, say, 4% economic growth, EPF members should get the same real rate of economic growth, must change it. So, so this is what, the members and all others will have to be, taking up with the government of Sri Lanka.
Right. Thank you, Dr. Vijayawardena. Moving to Professor Udara, just a question, just following up with what Dr. Vijayawardena said. So you spoke a lot about domestic debt restructuring, and but just asking because as we saw with the EPF and domestic debt as a whole, due to inflation, already the value has come down if you're looking at it in terms of US dollars. So isn't that sort of like, how would you argue with that? Haven't the banks, the EPF, ETF, and the insurance companies who have invested in domestic debt already taken a cut?
Well, I would say that people earning salaries have taken a much bigger cut. I'm sure salaries have an increase by 30-40%, right, in the last 6-12 months. So that gets to the root of the problem, though, because if salaries haven't increased to the extent that yields have, then we have a disproportionate burden of the crisis being borne by salaries and wage earners. And as a society, we have to decide on what is the equitable burden of the cost. It can't be that only one sector pays, and this sector being the most vulnerable part of the economy. So there needs to be an equitable distribution of the cost. And of course, the government can achieve this in different ways. The alternative way is to introduce much higher taxes on capital gains. And the big scary elephant in the room is a wealth tax. And the wealth tax is actually going to be something that you definitely want to avoid. And so that's why the sooner that the markets and the financial sector decide to are able to take ownership of this issue and drive the agenda for it, the more that these kind of more destructive policies, I would say, can be avoided, because the alternative is just to go into another crisis. So it's really the best of several bad alternatives is the way I would put it.
Right, thank you. I understand your point on the domestic front, but just to add on, like if you're looking at an equitable distribution of this thing, because it's usually some of the requests are coming from the ISP holders for domestic debt restructuring. You see, when you look at it in terms of US dollars, the domestic debt has already taken a cut, but the debt taken by the ISP holders had not. So that's how fair would it be?
So in terms of that, it depends on the haircut that you would give to the external bondholder. So I think the last traded prices back in March last year was around 40 cents in the dollar. So that would, to me, that would say that it should be a 60% haircut on external debt. So now you can say that inflation, it's very difficult to say what the inflation rate is, but if you take the exchange rate depreciation, it's been about 50%, I think now. So if the rupee comes back a little bit more, then we're roughly at the same place in terms of the two things. Now, the point I think that needs to be stressed is that restructuring domestic debt can have two forms. One is a principal cut, which is what the ISB holders will get. The other is reprofiling. Reprofiling is what the bilateral international creditors would get, and what we have been proposing for domestic debt. By reprofiling debt, it's not necessarily there's a loss that's incurred, because if the market yields come to 2019 levels, there is no loss, right? It's like saying, I will give you 10% on your debt today, even though the market rate is 20%, but then tomorrow the market rate is 10%. So what is the loss? There's a mark-to-market loss, which is an accounting loss for one day, but then the next day you recover this loss. And that's exactly the point that we want to get across, that in hypothetically, yes, there is a loss, right? But this loss is incurred by everybody no matter what, if the market yields don't come down. If the market yields do come down, there is no loss. So that's again why we propose, rather than a principal cut on domestic debt, to do the reprofiling, because that way you're essentially insulating the domestic creditors from this direct cost that would be in place.
Right, thank you. Yes.
Taral, hi, there are a few questions from the audience. If you don't mind,
Sure.
I can ask one or two.
Sure. Or you want me to? Yeah.
Yeah, sure. You can go ahead. If you
Sure,
can see
sure.
that opening. Yeah.
So a very popular question among the public, I think, been answered, but always coming back and forth, I can ask this to both of the speakers. With domestic debt restructuring, if it is to go through, like Professor Udara argues, can happen, and there's other views. How would it affect the deposits in the banks? Would there be this thing, because the central bank governor has guaranteed that deposits are all safe, but still there is a sort of uncertainty going around. So from the two speakers, your thoughts. Dr. Vijayawardena, you can go first.
Yeah, Mr. Rafi, it's a critical issue because in addition to the commercial banks, we have Savings Bank, the National Savings Bank, and we have the other savings bank also. And all these institutions are holding the savings of the people. And these savings have been made by these people by making a huge sacrifice. And therefore, they should naturally be worried about the safety of the money that they have saved with the bank. But if there is a financial tsunami that might, take place, the tsunami will not, distinguish between a good saver or a bad saver. It will affect the entirety of the financial sector. There are some plus points for our savers, our depositors. Plus, the point number one is that unlike the banks in USA and other Western countries, in the case of Sri Lankan banks, the loan book is, except the National Savings Bank, the loan book is very big. It's about, say, 90%, and the investment book is about 10%. So even if there's a, debt restructure, optimization by cut in the principal amount, the entirety of the loan book will not be affected. But the loan book will be affected, as Professor Udara also has mentioned in his presentation. There is rising non-performing loans because of the underperforming economy and the closure of the most of the small and medium industries. And also Professor Udara mentioned that despite the fact that there are many, SMEs have been closed down, large corporations are making either lower amount of profits or some are making losses. The banks have, expanded their bottom line. And if you look at some of the banks, they say they proudly announce that they have made a profit of, say, 5 billion in the first quarter. Some banks say they have made 7 billion. I have seen only one or two banks which had made in millions, all others are in billions. So how can this happen? This cannot happen. In an economy which is underperforming, economy is not growing, and the enterprises are not making profit, the borrowers are not making profits, and the banks are making huge amount of, the main result is that, they have taken advantage of the rising interest rates. And the Professor Udara actually very correctly attributed it to the increase in the lending margin. The margins have gone up. Now, as depositors, we have not been paid a sufficient amount of, interest, whereas as borrowers had been asked to pay a higher amount of lending. And in an underperforming economy, the borrowers cannot, just like the government of Sri Lanka, cannot meet that, interest expenditure obligations. So that particular problem is there. Then Governor Nandalal Wilson is correct, because we have this deposit insurance scheme in the central bank, which is actually made by the contributions made by the participating bank. But if all the banks, if there's a domino effect and all the banks fail, that money in the deposit insurance is not sufficient for the central bank to make the payment. Then we have the critical issue: can the central bank lend money to those banks? It cannot. It cannot unless those banks have, government securities as collateral. Now you can see, they have been hit on two counts. They don't have government securities, and at the same time, the central bank cannot lend without collateral. So this particular problem is again compounded by the ceiling which the IMF program has fixed on the central bank. The net domestic assets will have to come down by 200 billion by the end of this year, and it has to be maintained at that level during the entirety of the program, IMF program. So the prospect for central bank to lend money to these banks is also very remote now. Then who has to, rescue and bail out the banks? The bailout should come from the government of Sri Lanka, which is again in a very critical situation. So we have to, keep these, risk factors in mind and, make a proper choice about what would happen to our deposit with the banks.
Right. Thank you. Professor Udara?
Yeah, I think I agree with most of what Dr. Wijewardene has said. I just stress that I think the priority needs to be to ensure financial stability, to prevent bank failures and bank runs. And that's why the sequencing of all of this really matters. I think the recapitalization of the banks needs to happen first, and then with a very clear and quick execution of the domestic debt restructuring. This issue is just dragged on for far too long. It really should have been either not discussed or executed immediately after being announced. So I think this dragging on is creating financial instability. In terms of what will happen to deposit rates, well, I think in the short term there will be a compression. So deposit rates will go down. But if the country goes into another restructuring, then who knows what will happen. So that's again, it's not like we're facing a good and a bad outcome. It's the best of two bad outcomes we need to decide on.
Right. Thank you, Professor Udara. Just a question, I mean, for you, Professor Udara. A banker was making this argument that, the government requires banks to invest in liquid securities. So obviously, an thing is sovereign securities. So they are making the argument that, there is some sort of a push for us to invest in it. So we should be, exempt from certain cuts. What are your thoughts on that?
Sorry, liquid securities as in government securities?
Yes, generally.
Yeah, I'm not sure what sort of push the government is doing, but the private sector has opportunities to invest in different things. Now in Sri Lanka, the problem is that if you look at the actual investment opportunities, they've been very limited for very long because there's been always explicit or implicit capital controls, capital outflow controls. So you have the stock market and you have property and bonds. That's the kind of three main investment classes. So really in the current situation where there's a lot of cash floating around and the property market is tightening, there's really not much to invest in other than the stock. You take a risk on the stock market or government bonds. So I would think that the government should be able to meet at least whatever it can meet now without additional pressure, because where else can the money go? And unless I'm missing something. But I don't think there should be an entitlement for one particular part of the economy to be exempt from sharing the costs of the crisis. That's a principle that I work off.
Thank you. Dr. Vijayawardena, do you have anything?
Well, yeah, I think there is this requirement of a minimum liquidity ratio imposed by the central bank or commercial bank, which is 20%. And the liquidity has been defined as the cash that they hold, and also any bond that they hold with a maturity of less than 1 year. If they hold on to a bond, government bond, with the maturity of less than 1 year, then it is considered as a part of the liquid asset. So in terms of this, most of the liquidity requirements of the banking sector have been met by them by investing in treasury bills, which mature within 1 year, and also with the treasury bonds, which have a remaining maturity period of less than 1 year. So as a result, the regulator himself has asked them to put their money at this risky asset, which is now going to be maybe the liquidator. Because the investment in government security is considered as a gilt-edged investment, safe. Even in the central banks, capital requirements, the risk that will be attributed to these investments are 0%. Then the second one, I think they are referring to what happened when the prices of the international sovereign bonds went down drastically. Bonds maturing in 2030, the price came down to about, say, $25. At that time, unofficially, some of the leaders in the central bank had asked them to buy those bonds in order to stabilize the market. So they have, if they now say that, they have been driven to a bad investment decision, that is their own, problem. They must have their own internal assessment system to find out the risk that they might face in the event the government of Sri Lanka will have to default this investment, these bonds. So if they have done that without that particular analysis, Mr. Rafi, you can't blame the government or the central bank, you have to blame yourself.
Right. Thank you, Dr. Vijayawardena. I'll just ask one question, then I can give it to Professor Watawala if he has any questions. I'm sure he has. Just one last question. I've read your articles, always a reader. You argue that the Central Bank Act is not going far enough. to make the central bank independent. So if you can very briefly elaborate, because there's a lot of information that needs to be given to the public.
Yeah, well, of course, I mean, in most respects, you know, it has some positive developments, like the incorporation of the central bank rather than the monetary board. Then there is a separate monetary policy board that will be established within the central bank. And also you have taken the secretary to Ministry of Finance away from the monetary board, who has a vote carrying right now, and he is no longer a member. But you see now, all these things that had been introduced in the central bank new act have been negated by the fact that the governor is being appointed on the recommendation of the Minister of Finance by the President after getting the approval from the Constitutional Council. All the board members are being appointed again by the President on the recommendation of the Minister of Finance after getting the approval of the Constitutional Council. Deputy governors are appointed by the Minister of Finance. All these people sit on the two boards, the governing board and the monetary policy board. So you have taken one fellow who had been a problem for you, and you have now created 11 more fellows who would be appointed by the Minister of Finance, recommended by the Minister of Finance. So it actually negates the objective of making the central bank independent. That is one aspect. Second one is that now Professor Udara also mentioned that if financial institution would go into trouble, there must be a possibility for the depositors to trade in their deposits for shares, which is known as the bail-in. Now, presently, what is happening is the bail-out. If a financial institution goes into trouble, the government or the central bank will come and rescue the financial institution. So it is bail-out. And the bail-in is a concept where the stakeholders of the bank would bear the loss. The stakeholders are the depositors, shareholders, and the employees of the bank. And there are no provisions for the bail-in in the new Central Bank Act. And Professor Udara, I think, referred to this fact, and he said we need a new legislation for that. And you don't have to have new legislation. You could have introduced this in the new Central Bank Act itself. Then the most crucial thing is in the new Central Bank Act, there are no provisions for the central bank to control the privately developed cryptocurrencies. There is no any provision. Then also there are no provisions in the new act for the central bank to issue its own digital currencies. So you have to have a new act to control both the privately developed produced cryptocurrencies and also for the central bank to issue its own digital currency. Those are not available there. Then the appointment of the governor, you can pick up, the Minister of Finance can pick up anybody from the street and recommend that name to the President, and the President will send it to the Constitutional Council. And that's the way it is being done in other central banks like, say, the Bank of Canada or Bank of England. You start the appointment process of the board as well as the governor at least 2 years before the incumbent person would retire from the bank. And there is a separate body within the bank, which you call the selection body. Now, in the case of Professor Wattavala knows about this thing, because in the case of private sector, you have a selection committee, of the board of directors to select the new directors and recommend them to the board. The similar selection committees there, they will make the head hunting. They will have, and also people can make, nominations to this particular selection committee also. Then they will have, continuous regular discussions with those people who had been shortlisted. And finally, 3 names are recommended to the Governor General of Canada so that he can choose one name. Now, here in this case, you pick up somebody from the street and appoint him as governor tomorrow with the connivance of the President and the Constitutional Council. You have a big problem. So that is why I have argued that the present Central Bank Act has not actually made the central bank independent. And I have actually said, Mr. Rapi, you have moved on now. The IMF was fooled by Russia in 1990. When they extended the extended fund facility to Russia, the entirety of the money was stolen by the by Boris Yeltsin and the people inside the central banks of 22 billion US dollars. So I have said in the same way, IMF will be fooled by the Sri Lankan authorities also in 2023.
Yes.
By
Thank you.
enacting this new act.
Yes, thank you. I agree with you,
Malal,
because even
if
Yeah.
I can just mention a few things on what Dr. Vijayavardhana mentioned, that is really about the central bank, because you see, he is worried that someone from the street will be put as a governor of the central bank. But I don't know why they really did not consider that the person who is going to be appointed the governor is someone who has been in the central bank. I think we should ask for that, because then that person will have the experience, exposure of working, because we can't just people put out from outside. No, I think that is a very, very dangerous signal. So I think we should ask that they should be appointed from within the central bank with maybe say 10 years experience or 15 years experience, then that will solve the problem. I think Dr. Vijay, no, why don't we can also that?
Well, that is a good choice, Professor Vattavala, but of course the idea here is that if you take somebody from within the central bank, you are narrowing your choice set. But you take, a person from outside, but through a proper selection process, not by, giving the discretion to the Minister of Finance to select the man and, recommend to the Constitutional Council. Because if the Minister of Finance and the President are the one and the same person, it becomes so dangerous. You really, there are some people, standing, there is this Mugagaha next to central bank. There are people standing there waiting for the bus. You go there and pick up somebody and make him the governor of the center. It happened in the case of Uganda when during the time of Idi Amin. I mean, if you permit me to, relate that story, it will tell us, the hilarious situation. Now, Uganda's central bank governor was one of the top monetary economists from the University of Kampala. And Idi Amin had been used to ask the central bank to send him every morning a truckload of Ugandan shillings to his palace so that he can pay salaries to his employees, his soldiers. And this professor had thought that, this is a bad practice. So he got an appointment with Idi Amin. He had said, Your Majesty, what you are asking is wrong because it will increase inflation and inflation will have a cost on the ordinary people. So you have to, stop this. And he wanted to give a good monetary policy lecture to the president of Uganda. And Idi Amin had been, nodding his head throughout. At the end of the presentation, there had been a soldier who had been wearing a dagger in his waist. He pulled the dagger and cut the nose of the governor. The governor was bleeding now. Then he had asked that soldier, would you like to be the governor of the central bank? And what happened? That soldier was appointed as the governor of the central bank. So this can happen. I mean, if you cannot trust the people within the country to appoint good people to these positions, you must actually, as Professor Vattavala you have mentioned, you must establish the systems which cannot be violated by those people so that you will get the good people in these high positions.
Yes. Yes, agree, Dr. Vijayavardhan. So even in my talks and speeches, I've always emphasized the most important thing as the independence of the central bank. And even if you look at, for example, Germany, before it entered the euro, they were arguing that they had a very specific goal of price stability. And they said that even though it made German exports more expensive, it made the German industries innovate rather than compete on price. And that kind of led to how the German manufacturing industry became known for quality. So, Professor Vattavala, I'll give it to you if you for your questions, and after that, probably Ruchira can take the questions from the Q&A received.
Dr. Vijayavardhan, now we are talking of this, and when I hear these things, we are really, I don't know whether we are going forwards or backwards or whether we are going into the sinking well. I was just thinking, you see, because since we are all people, the accountants are on the financial area, are we not also looking at the financial stability and financial sustainability? Because I feel that will be a way that we can really be able to pay the debts, because if you want to pay the debts, you must have a surplus. Because all our private sector people who are here listening to it, they know that, because if their company doesn't have a surplus, they can't repay the loans and the banks will not give you money. But here, that is not an area that we are really very much emphasizing, because I think that should be the immediate thing of the government to have maybe financial stability and financial sustainability and get a surplus where we can repay the loans.
Well, that's the way out for Sri Lanka, because as accountants and finance managers, those in the audience, they are well aware, the permanent solution to come out of a debt problem is the growth in real terms. If the company doesn't earn enough money in real terms, make profits in real terms, it cannot come out of the debt. The same rule applies to the government also. If the government doesn't, allow the economy to grow, the economy is now, of course, we'll have to keep in our mind, this problem is not the problem of the government. This problem is the problem of all the citizens of Sri Lanka. So that's why I said the public debt has to be defined in the widest way possible, including the debt of the central bank, debt of commercial banks, debt of the private sector, raised through guarantees given by the government. And all these have to be, included in the debt, because at the end, private debt becomes public debt. Because if the private debt, the private people are unable to pay because they don't have a real growth, it is the taxpayers who will have to bear the burden. But in the case of Sri Lanka, with the negative economic growth for 2 years and a slowed down economic growth from 2024 to 2028, and there is no any investment in the real sector in Sri Lanka, with all these negative things that are developing, the government or the private sector is unable to meet its debt obligations. So it will become a huge issue for us. So our duty should be, as finance managers and accountants in CPA, CMA, we will have to come up with the policy paper, and that should be addressed to President of Sri Lanka, who is the Minister of Finance, and also Governor of the Central Bank, and take into account the views of the private sector as well. Now, at present, there is no consultation with people like you. The decisions are made in the Minister of Finance and the Central Bank in consultation with the International Monetary Fund. And there is already, large amount of, ideological debate going on in the world, criticizing this type of rescue packages being implemented by the IMF. And that particular group is becoming stronger day by day. So this is not the only option available. And as a result, there is this, accountants and the finance managers in CMA, they will have to, raise their voice now.
Thank you. Professor Udara, what is your view on this?
So can you repeat again? Sorry.
That's, now we have been talking of mainly the various matters relating to the economies. I was talking of the financial stability and financial sustainability, and also that we should have a surplus if we want to pay the loans. Otherwise, there is no other way that we can go ahead.
Right. So it's true that in the long run, well, so the question is so if you have a surplus in a company and you don't issue new debt, then the stock of debt will go to zero. Now, with a country, you don't need the stock of debt to go to zero. It just needs to be at a level which can be sustainable. Now, what sustainability actually means is very difficult to actually calculate. So often what's used is a rule of thumb measure, which is around 80% debt to GDP. And this is just from observation that whenever debt to GDP is around above 80%, countries tend to default. So the question is how to get back to this. And as I showed in one of my graphs, if the yields on Sri Lankan debt go to the 2019 levels, it will naturally come down to this level. So the question is how we can get the yields down, given that the government is moving in the right direction towards surplus. This is for sure needs to happen. And ultimately, the way this can happen is by Sri Lanka regaining access to the international markets. Now, of course, the international rates, US interest rates have increased, but looks like it's leveling off. But ultimately, by having capital flows in, this will lower the cost of borrowing and allow the government's overall debt burden to start to decline as the economy picks up. So I would focus, and this goes to a bit of the debate that Dr. Vijayawardena pointed out. There's a general criticism against the IMF's policies over the last 30, 40 years that they've focused on austerity, which is raising taxes, raising the surplus. In fact, if you look at the World Economic Outlook, which is the kind of main publication of the IMF that was released in last month, that's about 2 weeks ago, 3 weeks ago, they had a whole chapter there, and I recommend everyone to read it, which actually looks at the IMF's success on austerity-based policies. And they show that programs which have been austerity-based have been less successful than programs which have been growth-focused. Now, this is something that many countries have been saying. I know with Greece, people I've worked with have been advocating for this as well. The IMF allowing a publication like this in the World Economic Outlook seems to say that the IMF itself is understanding there needs to be a change in policy. So going to your question of doesn't the government need to raise its surplus, the fiscal surplus, I suppose what you mean. The answer is yes, but I would say the focus should be on growth and regaining access to the international markets, both of which require government credibility and solvency. And this requires ultimately transparency. And touching on what Dr. Vijayawardena said, it's very important that institutions and organizations like the CMA and its members really take on the responsibility to hold the government accountable. It's not a passive thing where the government in its little room in the finance ministry decides things. It's a public good that they're creating, and it's going to affect the country for many years, and they should be held accountable.
Thank you, Professor Udara. Ruchiri, over to you. I think we should go to the questions and maybe the large participants.
Yeah, thank you, Professor. Professor, I want to ask this question from Dr. Vijayawardena and also from Professor Udara. This question has come in a couple of times. So this question is mainly about the impact of DDR on financial sector, mainly on the insurance companies and also companies such as unit trust. What will happen to these companies because of DDR? I would like to first ask this question from Dr. Vijayawardena. Sir, I would like to hear your thoughts on this.
Well, if there's a financial tsunami which has hit us, and the waves have risen to say 30 to 40 meters, no one is safe. We cannot make a distinction between insurance companies, unit trust, and so forth. And happening right now is that in the case of Sri Lanka government has, through its deliberate policies, it has driven itself to now bankruptcy. And what did these insurance companies and unit trusts do at that time without making a proper analysis of their investments and, making a choice for in the future? Now all of us will have to suffer. I mean, if now, as I told you, if a situation comes where the government is unable to pay this debt, already this has happened in the case of the Sri Lanka development bonds. So if it happens to now, if you take the central bank out through the new Central Bank Act and the balance part, what would happen when the debt treasury bill limit has been increased from 5 trillion to 6 trillion? The government is going to borrow. Now those those insurance companies will have to now make a proper assessment of the investment, the risk involved in that investment, because the money to be borrowed by the government by these treasury bills is to be spent on the domestic or the consumption side of the government. And everybody knows that when you spend money on consumption, it doesn't generate revenue in the long run. So these people will have to make a proper assessment of the risk involved and make a choice now. Pretty soon, once the treasury bill limit is approved up to 6 trillion, it will be issued to the market. And it is those people who will make investments, they are thinking that they are getting a current rate of return around amounted 22 to 25%. It's a risk.
Thanks, Doctor. Thank you. Thank you very much. Professor Udara, would you like to add to this?
So regarding the insurance companies, I replied to one of the questions about this as well. My sense is that the insurance companies tend to have their problem is about duration matching with their liabilities. And especially life insurance, the duration will be quite long. So I would expect that reprofiling domestic debt to longer maturities would have less of an impact on them. Of course, there may be an issue on the shorter end of the yield curve, but given the most of the duration will be, the duration will be long, I wouldn't expect there to be such a big difference. There is this kind of accounting issue of the mark to market, what you do with this. However, the liabilities don't change. I mean, if the yields are 20% or 10%, the liabilities, the payouts on the insurance premiums are the same. So again, insurance companies would have been benefiting immensely in the last year with the higher yields. So I don't see a significant issue. There may be insurance companies that have short duration liabilities, and for them this may be a problem, and that's something that needs to be looked at, and the numbers need to be worked out. But again, it's purely a quantitative issue here.
Thank you, Professor. Professor and also Dr. Vijayavardhana, now there is another question asking what will happen to the debts of SOEs? So basically the question is asking, will the government stretch the period of loan payment period that is given to these organizations in order to settle the loans? What do you think?
Well, of course, in terms of the IMF bailout package, those SOEs which are selling a product in the market are required to fix the prices according to their cost. And already we have noted, even though the Ceylon Electricity Board has done it, it has not done effectively because the demand for electricity has come down, and as a result, the inflow of revenue to Electricity Board has come down. So they have ended up with a loss in the first quarter of 2023. So SOE debt, as I told you, is a part of the wider public debt. So if they default, it's the taxpayers who will have to bear the burden. So that is why there is a committee appointed by the president to look into the restructuring problem of these SOEs. And we don't know what has happened. The committee says it has submitted its report to president, and the report had been approved by the cabinet. So I don't know what had been recommended there, but it is better that, that report should be released immediately to public domain, so that we will also know how and when these, SOEs should be restructured. As it is, unless you charge the prices according to the cost involved, you will be making losses and you will not be able to repay your debt. Then there is another problem. Whenever there is a public monopoly like CEB or Ceylon the railway department or the postal department, the charge that you make is called a tax. It is decided by the government at the policy making level. So that's why we call electricity tariff, because it's a tax. So we are taxed. People are being taxed by the Department of Inland Revenue, by the Customs, by the Department of Excise. They all, tax us. Now, in addition to that, there is the CEB which is taxing us, CPC which is taxing us, Electricity Board, the Railway Department is taxing us, Postal Department is taxing us. All these people, because they are all got, and also the state universities. The state universities, if they charge, tuition fees from the students, it is a tax because it's a monopoly of the government, and therefore it's a tax. So this multiple level of taxation in a country may not be a feasible thing. So that is why SOEs will have to be restructured. The monopoly power has to be broken. Private sector should be allowed to compete with them, each other, and those are long-term structural changes which the government of Sri Lanka is required. But in terms of the IMF bailout package, they have to make a beginning, make a start right now.
Thank you, Dr. Professor Udara, I would like to get your comments also.
Yeah, I think the only thing I would add is that regarding the loans themselves, essentially they're government guaranteed. So the state-owned enterprises can't really default on them. I don't know how they're technically written, the contracts, but I would think that the loans the banks hold from the SOEs would have a government guarantee in place. So yeah, I can't really comment beyond this.
Yeah,
Okay,
I mean,
thank you, sir.
Professor
Yeah,
Udara,
yeah, doctor, please go ahead.
the more crucial public corporates like CB, CPC, when they borrow from banks, there's a treasury guarantee. And when the loans are not repaid, their auditors will qualify them in the final accounts. What is being done is, on the last day of the accounting period, the treasury will issue a letter of comfort. And the auditors accept that letter of comfort and they don't qualify the corporation, which is again a bad practice. And there are thousands of such, love letters that have been issued by the treasury to those corporations which are not being carried out. Auditors do not look at the capability of the treasury to meet the obligation in the letter of comfort. So this is a very serious issue with respect to the SOE loans.
So on the same, doctor, there's another section. This person is asking whether after restructuring SOEs, instead of loans, can we issue shares?
Yes, of course, it depends on, whether you are going to, number one, you have to first make it a public limited liability company in terms of the Companies Act or in terms of a separate act in Parliament. Then you can list it in the Colombo Stock Exchange so that the shares can be issued to the members of the public. But to do that, now if you take say a corporation like Sri Lankan Airlines, CPC or CB, which has a huge amount of debt obligations to outsiders, both in Sri Lanka and outside, you have to take those loans, that debt portfolio out of the balance sheet of the corporation involved and hand it over to a special purpose vehicle, which will agree with the lenders to service that debt over a period of time. So that you have first clean the balance sheet, issue shares. Otherwise, now know who is the member of the public or investor who is willing to lend, subscribe to the share capital of Sri Lankan Airlines, which is making profits about 100 billion per annum. No one is doing that. So you have to take the debt out of the balance sheet, clean the balance sheet, then you offer it the share market or whatever it may be.
Thank you, doctor. Doctor, this is about the new Central Bank Act. So this question is basically about when investors lose confidence and after implementing the Central Bank Act, will the government have funds to meet the essential expenses like salaries?
No, there are two constraints for the government of Sri Lanka. Now, those MPs who had approved the IMF bailout package were not aware of the implications of what they have approved. In terms of the IMF bailout package, the central bank cannot lend a single cent to government of Sri Lanka from the third quarter 2023. In fact, the central bank is required to reduce it by about 200 billion by the end of the year. So the government will have to find money by way of taxing people and also by borrowing from the market to pay salaries.
Okay, thank you, doctor. Maybe Mr. Rafi, you can now take over the moderation session for the final few minutes.
Thank you. Thanks a lot, Professor Udara and Dr. W. Vijayawardena. So any remarks from you all? 2-minute roundup. Comments? Thanks.
From us?
Yes.
Yeah,
your summary and your final take.
Yes. Now, perhaps, you might think that we have looked at the entire thing negatively. No. What we have done is we have provided enough material for all of you in the CMA and also all others who have joined from outside to think now. Because it is essential for persons like us as individuals and as citizens of this nation to make a realistic risk assessment of what we are doing in the future. Because if we cannot do that, we are failing in our duty. So my advice is that do not just blame me now. I have been actually branded as a doomsayer, but you'll be noticing what I have been telling from year 2010. After I retired from the central bank and everything has come true. It's not a doomsaying, it's actually a way of, thinking for the people. So our objective is to arouse interest in the members of CMA so that they can think, because they all have a brain, and then make a proper assessment of what you are going to take in the future.
Thank you.
Yeah, that's
Professor.
very well put, Dr. Wijewardena, and wholeheartedly agree. I think also in a practical sense, the feedback and scrutiny that CMA members can give also gives insights into how these policies affect all of the sort of nooks and crannies of the economy, so to speak. And these are things that no one individual can work out, and it only comes from individual experience and exposure to different issues. And it's these sorts of details which ends up derailing even very well-designed, well-intentioned policies. So there is a very strong practical element to taking on this responsibility. So thank you very much.
Thank you. And Professor Watawala, would you like to conclude? And
Yeah. Ruchira, anything else you want to say before I give the concluding remarks? Okay. Anything? Can I give the concluding, or you have anything to say before that?
Rosa, now we can conclude.
Okay, right.
If you don't have any questions to ask here.
Okay. Thank you very much. I think we've listened to the eminent speakers, and as to how about this particular thing on the domestic debt restructuring. And if you really see what we had a quotation from the IFAC blog, you know, what it says, restructuring domestic debt is like surgery. You only do it if you must, and you avoid it if it might do more harm than good. But I don't know in our current situation whether we have any options available, you know. We are in a very, from the what we heard from the our learned economists, is that things are very, very bad, and I don't know whether people have realized. Now, actually, the first thing that Dr. Wijewardena about the central bank appointments, you know, one of the reasons that our state corporations are in this current situation is that the appointments, you know, the appointment made by the ministers have really not had any sort of maybe criteria. So if the central bank is also going in the same direction, very soon they will also have to be restructured like the or privatized like the petroleum and the CEB and others which they want to restructure. And this. So they should really give some thought to it. And I feel that we need to have trust and confidence who are the people who are working in those institutions. So the majority of the appointment should come from there, but maybe one or two can come from outside. So that's what I really feel, and that will really save the central bank and also the state-owned enterprises. Then you mentioned about the electricity board, you know. I don't know whether the loss increased due to the less consumption, because I think what I read from the papers, they are saying that they will have to further increase the price. Then you further increase the price, then you have further sales being done, or your consumption will be reduced, then your loss will be further. But as per our solution of both the chartered accountants, the management accountants, is that you need to have financial discipline. The other thing is that you have to have costing. You have to have costing records. You see, every generation plan should give the value of the price of production of the energy, the kilowatt hour. Now, if you look at this privatization, no one realizes, because I saw in the papers that the hydro plants are going to be privatized. Today, if you see, the cheapest production of power is come from hydro. It is say 250. And that is subsidizing the high prices they are paying to the private sector. They are giving at 37, 40, so many high prices, but that is subsidized by this low hydro one. So if you give the hydro to the private sector, what you now get at 250, he'll supply at 5 rupees. Then what will happen? is the price going to come down or is the price going to increase? So there are a lot of complications and implications in this, and one need to do a cost of every area. Now I know that one plant, the gas turbines, 153 rupees. That is in the annual report of the CEB. Then those are the areas that they should privatize. No, why privatize the cheap ones and then get the customer to pay more? So I think people should know, because people are not using chartered accountants, they are not using management accountants, they are having no accountants. So this is what they are doing. You know, now, yes, today's papers say the Minister of Health is going to reduce the price of some of the drugs. You see, that should be, we should drop the price, you know. You have a cost sheet and put what is the cost, what is the landed cost. Then after that, what are the other costs? So we should have simple measures what people can understand. Not a minister to say it will go up or down, but it will go automatically. The digitalized system that is there. I think that is what the IMF should recommend, you know, digitalize all the government institutions. Look at the heavy costs. Today we are paying high taxes to pay the salaries of the government servants. 60% or the 70% is going for that. So that is what we are saying. Then of course, the interest, that is another 1 billion. Again on the interest. So additional amounts are coming. So we have to see how we can really do this. Then, of course, you made a very good comment on the report on the, that is to release the privatization commission report. I think that's a very good thing, because we also want to see that this will be properly done. It goes to the right people who have the right technology, who have the funding, who will bring the money in and then invest, and of course, ultimately benefit to the society. Now in CMA, we have what is called the societal cost. Societal cost means at the moment, all the inefficiencies, all the corruption, all the wastages are met by the society. But then privatization should remove all these things, the price should come down. So that's what we should have to see. I think these are the very good things that I think that can happen. Then of course, I mentioned about the then government guarantee. You know, those days, the worst corporation can go and get a loan from the bank because the government will give a certificate. Okay, you can get a loan, but the private sector, you think you can get a loan like that? No. So now those are the sins that we have to pay. Unfortunately, in this country, there is no accountability. Who is accountable for what they have done? These are basic lessons we learn in professional accounting. We have integrity, we have accountability, we have good governance. That is what we learn in accounting. So if they have more accountants, in fact, there was a survey that was done by name doesn't come to me, but what they found is globally, the governments that had employed more accountants, the corruption rate has come down. That is the biggest thing. You see, if you have them, then they will see that the systems are working. So these are very important things. And I think today we learned a lot of things, because as accountants, we are looking at maybe the most important things of the income and expenditure. But today we knew that it's not only the income and expenditure, but other things. But I can say that the solution is in the income and expenditure. Because if you have a debt to be paid, I don't know how we are going to repay the debt. Of course, if we have foreign direct investment coming in, if the other inflows of foreign exchange are going to increase, certainly that will bring in, which will be really not an income and expenditure, but is a cash flow. So government must employ, because actually the accountants are prepared to give their service free of charge to the government. They should have an expenditure committee. We will go and serve them. They should have the cash flow, monthly cash flow, how it is doing. Then for the income, how they can increase their income. Because it's not only taxation. No? How many people are not paying taxes in this country? Is it there? That should be the target that should be given to the Inland Revenue Department, because the salaries, people whose salaries automatically come, they don't have to do anything. But the people who are not paying taxes, they should bring. So if they actually bring that money, I think this deficit can be easily bridged. So I think we need to have a new thinking. We have to see how it could be done. So I think this webinar has given us new thinking and also realized the importance of the professional management accountants. I think both of you, both Dr. Vijayawardena, Professor Udara, both of you all mentioned, and of course our moderator Talal Rafi also mentioned that. So I think that shows that it is really real. But I don't think that we are playing that role in the private sector. They have the stock exchange, they have the Colombo Stock Exchange, the Securities Exchange Commission. They are controlled very well in that. But government, what is the control they are having? If they have such things, if they have it for the private sector, why not for the government sector? Because they are appointed by the people of this country. You think they don't have to have management? They should be properly managed. And also they should be brought to book if anyone has mismanaged, if anyone has done anything wrong. Today we don't know. Now we are having maybe over 100 billion debt. Who has, why was this debt done? You mentioned about the Auditor General. He also should have gone through his accounts, no? If we are unable to repay in the case of private sector, they say you're insolvent. You are not solvent. Your balance sheet is not solvent. So I don't know whether the government has a balance sheet, because I feel that this balance sheet has not been tabled in Parliament. If it was tabled in Parliament, the government members will know what are the loans that they have taken before they issue a fresh loan. But this is the way that things should be done. And there is according to the International Federation of Accountants, they have issued public sector accounting standards. That should be done. So if they want to maybe implement that, then they must get the chartered accountants, management accountants, he will do it for them. So I think there has to be a major restructuring everywhere. Now you were talking about the education. I think everywhere it has to be done, because when a graduate comes out of the university, 26, 27 years graduate. In other countries, they have a master's and a doctorate. Doctors may be further than that. And today all the people are leaving the country. So very soon we will not have any skilled people. We will be only talking. We will be able to get you on the online and maybe address us, you know, but then unfortunately there will be no one to do this job. So I think we are in a very serious situation. And although the private sector is generating all the income that is coming, all our professional accountants, majority of them are in the private sector. So we need to see, the government should realize that and get them, and we are prepared to help all of them, because costing is the base of everything. With the depreciation, the prices double. Now, the currency has strengthened, you know. Now today, I think it is very much less. It has, I think, about 320 or 318, or the buying is some 290 odd. So it has come down. So if it has strengthened, then automatically these there should be an adjustment, but it really doesn't happen. So let me once again thank everyone. I must thank our two speakers, Dr. Vijayawardena. I think he's always been there with us and been helping us, and Professor Udara Piris, because I think it's very early morning for him, but still he made his sacrifice. Actually, there was another person also from Verite who was done, but then he accepted it last moment. So I'm extremely grateful to you, Professor Udara, for being here. And of course, Talal Rafi, our moderator, who's done an excellent job. I know that he's also very closely associated with all these international agencies, IMF and others, and they have great respect for him, for his articles, for the work that he's doing. And of course, our own Ruchira Pereira, who's here, who's been making the various announcements and done well at the Q&A. So let me, with those final comments, thank our participants for their participation. I must tell you that there were about 800 people who were registered, and we had nearly, I think, about 400. Normally, that's the pattern in this, because I must rather say a special thing, because we are giving this free of charge, and our speakers, eminent speakers, have done all their work voluntarily, and I must thank them very well for them, for educating our people and also telling the problems and how we can get over these. So thank you very much, and we will end the webinar with this, and we do hope that every day something new is happening, that the next webinar that we'll be able to get another topic that we can handle. Thank you, and all the very best.
Thank you, Professor. Thank you, Dr.
Thank you.
Vijayavardhanan. Thank you, Professor Udar.
You can leave now.
Trophy.
Thank you
Good
all.
evening.